Hi, Gautam. Good morning and good evening to you since you are in the US.
Thank you, Shaina. Pleasure to be here.
So, is my voice clear?
Voice is clear. Is my voice clear and the video clear?
Absolutely, absolutely. So, okay, so let's begin then. It's 12 and let's begin sharp at 12. So, welcome everyone. Thank you so much for joining this Sunday morning, and thanks to our very, very esteemed guest, Mr. Gautam Baid. So, to give you a brief introduction, Gautam is a founder of Stellar Wealth, which is a SEBI-registered research analyst firm. He's a small case manager for investing in Indian stocks. He's the founder at Chapter, which is a learning platform where he's teaching the discipline of investing, and not to miss Gautam's international bestseller, The Joy of Compounding, which has helped so many investors and so many people in general gain such an amazing perspective on value investing. Gautam has been a portfolio manager, and he's been profiled in the Morning Stars Master Series. So, and we see him at various digital platforms. We see him in social media, sharing his knowledge and acumen with us. Thank you so much, Gautam, for being a part of our live Insta Live for FinMedium, where we actually aim to educate and share our knowledge with investors. So thanks so much for being a part of this talk today.
Thank you for the kind introduction, Shaina. It's a pleasure to be here.
Thank you so much. So Gautam, I'll start straight away because I think let's start this Q&A, and after that we'll have live questions from all the people, and we have lots of people who have joined us today. So, so to begin with, your book is based on the principle of value investing, and you yourself have value investing as one of your core ideas in investing. So why do you think that the value investing philosophy, Gautam, has endured all this while? What makes it ever so green?
It is because the principle of buying something for less than what it is worth will never get old, right? So Phil Fisher had rightly said that the stock market is filled with individuals who know the price of everything but the value of nothing. Stock price is known to everyone in the market, but value is understood by only a select few. And the stock prices randomly fluctuate every day, sometimes wildly on either side. But the underlying business value changes very slowly. And therein lies the big opportunity for us as value investors. Focusing on what is moving is part of our evolutionary instinct. And that explains why market participants focus more on the volatile stock prices, which keep bobbing about up and down every day, rather than on business values, which change very slowly. Capitalizing on others' desire to avoid downside volatility is what makes value investing work. And Joel Greenblatt had very aptly said, value investing works, but value investing does not work all of the time. And that is why value investing works.
Right, right. Yes, yes. So, Gautam, to take it from here, how has your investing journey evolved over years? What were the core ideas that you started with, and how have they evolved over the years, and what have you inculcated in your years of learning?
So my personal investment philosophy and personal opportunity set has significantly expanded over the years with time and experience in the markets. Initially, it was restricted to low price to earnings and low price to book stocks because I started off like most investors do by reading Benjamin Graham's Intelligent Investor. Later on, I read about Warren Buffett, Charlie Munger, and Phil Fisher, and started investing in high quality businesses at a fair to high valuation price. But today, it covers multiple areas of the investment universe, including deep value, cyclicals, commodities, turnarounds, and special situations like demergers and reverse mergers. Instead of being restricted by my personal biased views to a small opportunity set, as was the case in my early years, I am now able to hunt within a much more wider universe wherever I find mispricing of value and a highly favorable risk return trade off. And you see, no single strategy works all of the time, and in every kind of market. And that is why it is essential to build one's investing arsenal to be able to hunt for value from within different areas. And over the years, I've come to realize, China, just why this is so critically important. It is because a bull market is always going on at all points of time in some specific sectors of the Indian stock market. For instance, even during the 2009 to 2013 bear market in India, IT services, pharmaceuticals, and FMCG created a lot of wealth for investors. And new trends always emerge during the fag end of a bear market. And that is the time when most amateur investors and new investors are busy averaging down their losses from the previous bull market leaders, which have started collapsing, rather than looking for the new sectoral trends which have emerged. For example, after the COVID crash of March 2020, multiple trends have just accelerated. Many trends which were already in force, they have been further accelerated because of COVID. So, for example, e-commerce, digital transformation, cloud computing, the use of technology. All these mega trends have just accelerated post COVID-19. So, we should, as investors, always be on the lookout for where the mega trends lie, because that is where the really big money will be made over the long term.
Right, right. So, considering all these factors, what is your investment checklist incorporate?
So that's a very good question. And a prudent investor never purchases ownership in a business without conducting the necessary due diligence. So study about the company and its competitors from information on the internet, company website, and the various company filings. You should have a look at the unlisted competitors as well. There's a website called Toffler that you can get a lot of information about private companies in India. After that, study the last 10 years of annual reports, proxies, notes and schedules to the financial statements, the management discussion and analysis section, or what we call the MDA. Within the MDA, you should check for changes in management tone and industry outlook, and also observe the recent trends in insider shareholding. After you have concluded the initial groundwork, proceed to study the following parameters in checklist fashion: income statement analysis, balance sheet analysis, cash flow analysis, operating efficiency analysis, returns ratio analysis, management quality analysis, and a psychological checklist of the standard causes of human misjudgment. All these 7 different checklists are elaborated in detail in my book's chapter on checklists. And it is very important to understand and realize and note that the ideal checklist is subjective, and it varies from situation to situation and from individual to individual. For example, the primary checklist items you look at when evaluating deep value, commodities, cyclicals, or special situations, these are shorter term tactical opportunities. These are the primary checklist items for these are very different from the primary checklist items you look at when you're evaluating long term secular growth companies, where quality of business and quality of management is the most important.
Right. So, talking about your book, and it has a comprehensive, if an investor goes through it, they can really, and follows it diligently, they can really smoothen their investing journey. So in your book, you also talk about psychological biases and how investors fall prey to it and, lose out on big opportunities or something that they already have in hand. So, how do you, can you give an example of how you define a psychological bias, maybe from your real life, how you've just avoided falling for it and made a successful investment?
Sure. So in my book, I've talked about my investment in a company named HEG Limited in 2017, on which I'd made a pretty big profit. And I'd exited my first investment in HEG on 1st February 2018. And 1 month after the date of my sale, I came across a news report in the media which mentioned that graphite electrodes, which was HEG's main product, were selling at a higher price per metric ton in the market. And the supply situation in the market was becoming even more tighter. When the facts change, you should always change your mind. I immediately repurchased HEG, this time with half the percentage allocation I had at the time of my previous exit. And in one single go, I was able to overcome a host of personal biases that had affected me since the beginning of my investing career, namely commitment and consistency bias, anchoring bias, and status quo bias. And let me just quickly elaborate a bit on these 3 biases and why they are so harmful for investors. Commitment and consistency bias means hanging on to or just being consistent with your prior views, even though the underlying facts have changed. But investors need to understand that to be successful in investing, the idea is not to be consistent. The idea is to be right. And it doesn't matter whether the right information comes from your own research or comes from anyone else. The only objective should be to be factually correct. So commitment and consistency bias should be just avoided at all costs. Commitment bias, within that bias, basically refers to mentioning something positive or good about a business publicly, and then just being forced by public pressure to hang on to that particular position, even though the underlying fundamentals may have worsened. An easy way to avoid falling prey to commitment biases and consistency biases to avoid speaking about your holdings on social media or publicly. That's the most easy way. Just discuss your stocks with your peers and colleagues with whom you have your regular discussions, but avoid making a public statement about the virtues of a business, because as we have seen so many times in the last many decades, things can change on a dime here. I mean, just there have been cases of even very highly talked about and highly praised companies later on turning out to be fraudulent. So it's much more better to be right, just focused on being factually right than being consistent. So that's the first one. The second one was anchoring bias. And anchoring bias refers to clinging on to a meaningless reference point, like, for example, the cost price. And to be a successful investor, you should immediately forget the cost price or the purchase price you paid for a stock the moment you buy it. Otherwise, this will forever affect your judgment. The price you paid for a stock is a sunk cost. It means nothing after that, right? All that matters is the potential returns from a stock from the current market price. What you paid for it in the past becomes completely irrelevant the moment you have purchased it, because it's a sunk cost. So that's anchoring bias. And the final one is status quo bias. Human beings are biologically designed to conserve energy. We want to mentally conserve as much energy as possible. And status quo bias here basically refers to sticking on to a bad investment, sticking on to a bad relationship, sticking on to a bad decision, just because you want to avoid making the effort to admit that you made a mistake and not making the effort to move on. But the idea is to be rational, and rational investors, rational individuals treat all past decisions as sunk cost, and they're always evaluating things based on opportunity cost, based on where we stand today. So these are the three important biases which I was able to overcome, and this is why the HEG investment will always be very special to me. It was a big step forward in my evolution towards rationality. I finally exited my second investment in HEG in August 2018 at a good profit, resulting in a total compounded profit of more than 350% on this company's stock in less than 1 year through the two investments I had made in this stock. So that's an example of how I was able to overcome a lot of psychological biases.
Wonderful, wonderful. And I think I have noted this point, not to be consistent, but be factually right. I think I'm going to put it in bold letters, because we find a lot of pride in being consistent, and then that's where we just get carried away with that pride and ego that
There's one more misconception I would like to clear here about many investors in the market. Oftentimes long holding periods in a single stock is considered a virtue here, but I keep telling people the idea is not to just be stuck in one company for the long term. The idea is to remain invested in the stock market in a portfolio of good stocks for the long term, because it may so happen that you have purchased a very good company at a good price. It suddenly gets re-rated to suppose 150, 200 P multiple. Then that is the time to evaluate and just get out of that particular company and get into a better opportunity. So the idea is to remain invested in the stock market in a portfolio of good stocks for the long term. And again, the stock market teaches us that there is a big difference between a great business and a great stock. So that is something which we always have to keep in mind.
Right. So Gautam, could you just walk us through an example where all the analytical principles, tools, and processes that you have mentioned in your book, how they come to play in real life?
So traditionally, there have been three sources of advantage for the individual investor. The first source was the information edge, but with the advent of the internet and widespread dissemination of information, the information edge is gone. The second traditional source of edge for the investor has been the analytical edge. But with more and more smart people entering the investing profession, even the analytical edge is fast getting compressed. But the one edge, which is the most durable and sustainable in my view, is that of behavior and temperament. And I've talked about the same in elaborate detail in my book's chapter on delayed gratification. And implementing the principles from that chapter have helped me achieve some of my biggest multi-baggers till date. And I would like to illustrate this with the help of a personal example. During 2018 and 2019, post the NBFC crisis, the Indian auto sector entered a severe downturn. And an auto ancillary company named Rajratan Global Wire was undergoing a big capacity expansion. Because the entire sector was out of favor, investors' attention on this particular stock was low. But as soon as the capacity expansion got completed and the earnings visibility went up post a recovery in the auto cycle, the stock of Rajratan Global has given more than 1100% returns since April 2020. This is why Howard Marks has said, rule number 1, most things will prove to be cyclical. And rule number 2, some of the greatest opportunities for gain and loss come when people forget rule number 1. Most of the businesses in the stock market are cyclical in nature. The idea is to buy these big capacity expansion plays when the industry is undergoing a down cycle. After taking the company's balance sheet into account, whether the company can survive another 2-3 years of the industry downturn, you buy them at deep value to their intrinsic value. You buy them at a deep discount to their intrinsic value, and then you just patiently hold on till the industry enters an upturn. So from bottom to the peak of the cycle, this is how you may reap maximum capital appreciation, and this is deep value investing at its finest. So this was a example of how I was able to utilize some of the principles from my book's chapter on delayed gratification.
Right. Then that's very useful, and information that you should keep going back to, keep reminding yourself that. So another thing, Gautam, that there are talking about retail investors. So we have seen a lot of foray of retail investors into the stock market, especially off late in the last couple of years. So there are certain finer nuances to individual position sizing. So what should be the initial allocation, and how do you go about pyramiding that? So in that, how do you actually evolve, and how has your experience been, and what is your message to a retail investor to take on that process of pyramiding?
Sure. So I size individual positions according to my evaluation of potential risk, with the largest allocations in my portfolio having the lowest likelihood of permanent loss of capital, coupled with above average return potential. I size new positions with a minimum weighting of 3 to 5%, and subsequently average upwards or pyramid upwards if the management executes above my expectations. And it's very important to understand that individual position sizing is important not only for its impact on overall portfolio performance, but also for one's mental peace of mind. I sell down to my sleeping point if any single position becomes a discomfortingly large percentage of my total portfolio's market value. And because I do not want any single position or single company or a single promoter to determine my life's outcome. So prudence is always maintained at all times at the portfolio level, both in terms of individual stock specific allocation and individual sectoral allocations. This is very, very important. You basically want to diversify and reap the full benefits of diversification while making sure that you're not diluting the return potential of the portfolio. So that's a pretty dynamic art, the portfolio management piece. And one should have higher weights in businesses with disciplined capital allocators, healthy growth prospects, and durability and longevity of growth. As Mae West very nicely said, too much of a good thing can be wonderful. So that is what you want to achieve as an investor.
Right. So another thing that I found very interesting that you talk about, and you've also written about it in your book, which says that the frequency of correctness does not matter. It is the magnitude of correctness that is the real thing. So do you want to elaborate a bit on that?
Sure. So anyone can pick a winning stock, but the great investors differentiate themselves through superior individual position sizing. Given that the average success rate of even the best investors in the world is less than 50%, it really does matter that when you find a winning idea, you make it count. When you come across a truly great stock idea, you should buy enough of it to make a meaningful difference to your life. And that is why it is very, very important to keep to think in terms of the impact on the overall portfolio. And this is what George Soros basically was referring to when he said that it's not whether you're right or wrong that's important. What matters is how much money you make when you're right and how much money you lose when you're wrong. And as investors, it is essential to incorporate and inculcate this expected value way of thinking when we're making investment decisions. So what really matters at the end of the day is your slugging percentage. Investing is not a game about batting average. It's all about the slugging percentage. How much you're making, whether you're really making your big bets count. I talked about Rajathan Global a few moments back. And at the end of the day, you'll notice most of the big investors in the Indian stock market, almost more than 80-85% of their overall net worth has been created by less than 10-15% of their overall investing decisions. That is how any successful investor's portfolio will look like at the end of the day, because investing is a probabilistic activity. It's a place where even if you follow a good process, you may end up making a loss at times, and which is absolutely fine. Only if you keep thinking about individual winners and losers all day long, then you'll end up being miserable, even though you make very good returns. Just focus on how much you're making at the portfolio level, because a large part of your overall portfolio returns will be driven by just a handful of big winners. That's all. But you have to ensure that you let your winners run. That is the key.
And and also have big positions in those winners, so that will need a lot of conviction in those winners, and you stay true to that conviction.
It will automatically happen. So if you let your winners run, so I'll explain this with a good example. So you start with a diversified portfolio, 20-25 names, and then you let your portfolio naturally concentrate itself. That will automatically happen if you let your winners run, because over the long term, what will happen? 5-6 stocks will become 10 bagger, 20 baggers. They'll basically end up constituting more than 70-80% of the portfolio, and the losers will automatically fall by the wayside automatically. If you do it, like Benjamin Graham said, the biggest enemy of the investor is himself. We end up harming ourselves because we tend to take profits of the winners and we tend to just stick with our losers. Don't do that. Just let your winners run. You'll yourself observe over the long term, your portfolio will naturally concentrate itself in the winners, and they will deserve their high allocation. Let your big winners deserve their high allocations over time.
Right. You also mentioned something on the lines of culture being a moat in your book. Could you explain that?
So we often discuss the traditional sources of competitive advantage like pricing power, high switching costs, network effects, distribution advantages, etc. But in my view, a less discussed, less appreciated, and a difficult to replicate competitive advantage is that of culture. Culture is best exemplified by companies such as Berkshire Hathaway, Costco, Nebraska Furniture Mart, Geico, to name a few. And to illustrate the significance of culture, consider this. Between 1957 to 1969, when Warren Buffett was running the Buffett Partnership hedge fund, he did not mention the word culture even once in his letters to investors. But since from 1970 to 2020, when he was running Berkshire Hathaway, he has mentioned the word culture more than 35 times in his annual letters. As investors, we are looking for companies and organizations that are fanatically obsessed with the well-being of their customers and empathize with them more than their competitors do. And culture matters to long-term investors because it empowers the company's employees to perform their daily tasks slightly better than their competitors do. And over time, these tiny advantages compound into much larger advantages, which persist for much longer than conventional wisdom suggests. And the answer to the question, what will widen the company's moat, should always drive the management strategy and the corporate culture. For Facebook, it is all about driving user engagement on its various social media platforms like Facebook, WhatsApp, Instagram. For Amazon, it's all about improving the customer experience in terms of flexibility, options, speed of delivery, and wider selection. And for Geico and Costco and Nebraska Furniture Mart, it's all about sharing economies of scale with their customers in the form of lower prices. When we are investing in companies that are widening the moat, over time, they invariably turn out to be much more valuable than the results from our initial valuation work. And this is the significance of focusing on the softer intangible aspect like the company culture.
Right. So, you're the founder of Stellar Wealth Partners, and mostly, as we were discussing earlier, this Stellar Wealth specializes in identifying the emerging and fundamentally solid businesses on the principles of variant perception and long-term structural trends. So, do you want to elaborate these themes, because variant perception is not a very popularly known theme, for investors per se.
Yes, so variant perception refers to having a differentiated view on the short to medium term trajectory of a business, and it refers to situations where you get ROC expansion coupled with earnings growth, and you get valuation re-rating, and you end up getting multi-baggers. And there are multiple triggers for variant perception. Number one, a product mix change. A company may opt in for entering into manufacturing of higher margin products, and higher margins may lead to ROC expansion. That's one. The second source of variant perception is that of a company incurring a very large capacity expansion or capex. And there are three ways a company can engage in capex: debottlenecking, brownfield, and greenfield. Debottlenecking basically refers to spending a very nominal, small, modest sum of money to get much more throughput and much more output from the same capacity which you have. Brownfield expansion refers to installing a new set of machinery within the existing plant and getting more output. And greenfield refers to setting up a new plant altogether. Between these three forms of capex, debottlenecking gives you the highest margins and ROC, followed by brownfield, followed by debottlenecking. So as investors, we can get the benefits of variant perception if we can simply focus on companies which are debottlenecking their capacity and getting ROC expansion. There have been a few companies in the recent few weeks which have actually done this and made their announcements on the Bombay Stock Exchange, and I think the delta in earnings in these cases will be very high. So that's another trigger for variant perception. Next source of variant perception is that of operating leverage. So once the capex has been done, once the pre-production costs have been recovered, after that, majority of the revenue, basically, a lot of that starts flowing down to the bottom line. So that's very simple form of operating leverage. The next source for variant perception is that of deleveraging. So a company may sell off its non-core business or a loss-making business, pay down their debts, and as debt goes down, interest costs go down, net profit goes up, market cap goes up. Also, whenever any company or conglomerate sells off its non-core business, the stock market rewards it with a higher valuation multiple, because the stock markets like focus, and that's why you'll see in the stock market many conglomerates get what is known as a conglomerate discount. So selling off a non-core set of operations is also a source for variant perception. The next source of variant perception is that of an industry cycle shift. So since middle of last year, we have seen how the residential real estate cycle in India has turned around after more than a decade. And real estate is a deep cyclical sector. The down cycles last very long, and the up cycle also lasts for a very long time. And this is where a really big amount of money can be made over a period of 4-5 years. So that's another source. Finally, we have regulatory change in the form of a government regulation change. So we have seen how the government's emphasis on ethanol blending since the last 1.5 years has led to so many multi-baggers from the distillery space, and it's still continuing. Another source for variant perception is through corporate actions like demergers and reverse mergers. And in case of demergers, there are two different sets of demergers which can lead to. So there are different forms of demergers, but the really big money in demergers is made when you get the element of forced selling. And forced selling takes place in two situations. One is called a market cap demerger. The second one is a sectoral demerger. So I'll give you a good example of a market cap demerger. In August 2020, Aarti Surfactants demerged out of Aarti Industries and listed as a microcap. Now, what happened in that case was, because there were many institutional shareholders of Aarti Industries, they were handed this tiny microcap named Aarti Surfactants, and they just wanted to have nothing to do with it. So they wanted to just dump it at any price they could get in the open market. And that's why you saw the price of Aarti Surfactants falling by almost 50% within a few days after, a few weeks after a demerger. And you were able to buy that particular business at a great discount to its intrinsic value. So that's an example of a market cap demerger. sectoral demerger basically happens when you basically get a demerged entity out of a parent company which has been formerly held by many sectoral funds. So in case of so you had a company called Jubilant Ingravia, a chemical company, which got demerged out of Jubilant Life Sciences, which was primarily held by many pharma funds. So even though Jubilant Ingravia listed at a decent market cap size, because to dump the shares of Jubilant Ingredient, the opportunity to buy that business, which is a cyclical business, fine, but you were able to buy it at a very cheap price. So the really big money demergers is made through market cap demergers or sectoral demergers. The next one in this same category of corporate actions is that of a merger arbitrage. Just in early 2020 and in mid 2020, you had APL Apollo announcing the merger of Apollo Tricord with itself at a 1:1 merger ratio. And in July 2020, you had Equitas Holdings announcing the merger of Equitas Small Finance Bank with itself at a 2.26 to 1 merger ratio. Just look at the stock prices of these four companies as they prevail today, and just you'll yourself figure out whether there's an arbitrage opportunity to be made. These kind of merger arbitrage opportunities are simply a play on impatient human nature. Many market participants are not willing to wait even 3-4 months for a merger to get completed. But when you add up all these small gains, 10, 15, 20% gains on these special situations, and when they compound up over time, they become very, very significant. And finally, a very powerful source for variant perception through corporate actions is that of promoter and management change. So in August 2020, the stock price of CG Power was below 10 rupees. And it was mired in big controversy. Just the previous year, 3,000 crore rupee fraud had been uncovered in the company. In August 2020, entered the Murugappa Group from South India, a group with very high standards of corporate governance and a stellar reputation. Whenever a business with low perceived standards of corporate governance is taken over by a business group with very high standards of corporate governance, you get multi-baggers. The stock of CG Power in the last 1.5 years has given more than 2,000% returns ever since the acquisition by Murugappa Group. So, promoter and management change, merger arbitrage, demergers, these are great sources for variant perception. And seller wealth flexi cap small case is primarily based on variant perception. That is what we focus on. Here, I would like to mention a very, very important principle of value creation for all your viewers. There are two kinds of companies in the stock market. One with low returns on capital, one with high returns on capital. In case of the former, the companies with low return on capital, the maximum delta, the maximum rate of change, the maximum intrinsic value creation happens when they focus on improving their return on capital employed. And in case of companies with high returns on capital employed, the maximum delta, the maximum rate of change, the maximum intrinsic value creation takes place when they focus on increasing their top line growth. So I already talked about the variant perception category. That is where we focus on companies with low or average returns on capital employed, in which the ROC expansion is about to happen. That's variant perception. The second category which I talked about, companies with high returns on capital, where they have to focus on increasing top line growth. In stellar wealth mega trend small case, that is the category we focus on. We focus on long-term structural trends. And long-term structural trends are found in industries with a very favorable structure. They are either organized as a monopoly or a duopoly or an oligopoly at best. They are experiencing some form of an industry tailwind. They have consistency and predictability of cash flows. They have a long runway for growth because the total addressable market size is very, very large. You also get value migration. So in India, you have got value migration from unorganized to organized, from public to private, taking place for a long, long time. And there are multiple structural growth plays available in the Indian market today. You have got contract development and manufacturing organizations. You have got contract research and manufacturing services. You have got music streaming. You have animal healthcare. You have fintech. You have e-commerce, digital transformation, cloud computing. And within autos, you have electric vehicles. Within electric vehicles, you have to be careful. In the OEM space, you would rather want to play it through an auto ancillary space, preferably through auto ancillaries, which are the sole supplier to electric vehicle companies. Because what creates friction in value creation? It is competition, right? So let the electric vehicle OEMs fight among themselves. You want to basically find a consolidate. You want to study the value chain of the industry and find the area in which the consolidated profit pool lies. Consolidated profit pools, or basically that is where the really big money is made. You want to minimize competition and minimize friction so as to maximize your capital gains. So this is what we focus on in the mega trend small case. So variant perception, that is telewealth flexi cap, and then the long-term structural trends or mega trends, that is telewealth mega trends small case, and both are benchmark agnostic portfolios of 25 to 30 names each. In case anyone wants to understand why the rationale for this number of stocks in both the portfolios, it is because that is the optimal number of names to maximize the risk return trade-off. As per a study published in the international bestseller A Random Walk Down Wall Street by Burton Malkiel, it was shown that as the number of stocks in a portfolio approaches 25 to 30, you have basically captured almost 99% plus of the benefits of diversification. And at the same time, this is the sweet spot for an active investor wanting to outperform the market, because the number of companies you want to know is still manageable, and you have managed to capture all the benefits of diversification. So that in a nutshell is what Stellarwealth Partners focuses on.
Great, great. So that really was a great summing up on a lot of fundamentals that we may or may be confused about. So another thing, when you were talking about, for instance, reducing the debt or return on capital employed. So do you have a certain numbers that form a baseline that, okay, it has to be this much, it has to, ROC has to be about 15%, or the debt has to be lower than whatever one, or, I mean, do you have a certain set of parameters, or do you still relatively see it, with respect to the company that you are, participating in, and consider other factors? Or are these set of numbers fixed for you that, I'm not going to invest if this is not met?
Nothing is fixed in investing, Shaina. It's all about the trajectory. As an investor, I'm only concerned about the trajectory of the ROC and the earnings growth. If the trajectory is upward, I'll make money if I buy it at a decent price. If the trajectory is down, future trajectory is down, I'll end up losing money. So in one of my past recent presentations, I've talked about a deep value cyclical company, which basically reported a small loss in the latest financial year ending in March 2021. Now, if you were using a mechanical screener to look for companies with net profits above zero or positive net profits, you would end up missing such opportunities. That company has more than doubled its gross block, more than doubled its fixed assets. The reason for the small loss in the latest financial year was that they had shut down their existing plant to synchronize with the upcoming plant. So they didn't generate any revenues for 4-5 months, and this fixed costs were still incurred, and they ended up making a small loss. But if you screen mechanically using screening tools, you will end up missing such opportunities. So investing is much more than investing. Success is much more than just looking at P ratios and using mechanical screeners. You have to put in the work, and there is no alternative to hard work in the stock market. But if you do put in the hard work, and if you're sincere, this is a place to become really successful in the long term.
Absolutely. Another thing I was keen, to know, since you're an author yourself, apart from your own book, give us a name of your top 3 favorites or top 5 favorites, that you would really recommend, and maybe they're investing or non-investing books, but your favorites.
Sure. So I'll share 3 investing books and 3 non-investing book recommendations with you. So as far as investing book goes, I think beginners should start off with Peter Lynch's One Up on Wall Street. They should also read Phil Fisher's Common Stocks and Uncommon Profits, and Howard Marks' The Most Important Thing. I think these are great books to start with. And and the Berkshire Hathaway annual letters and Warren Buffett's original Buffett partnership letters and the Berkshire Hathaway owner's manual. I think these are also essential readings for all investors. As far as non-investing books go, I would recommend More Than You Know by Michael Mauboussin. I think that's a great read on multidisciplinary thinking. Same thing with Seeking Wisdom by Peter Bevelin. That's also a very good read. And finally, Poor Charlie's Almanac, which has been edited by Pete Kaufman. That's also a very good book for multidisciplinary thinking. So I think the basic raw material for any successful investor is to have very high levels of insatiable curiosity and a passion for learning and reading. And there can be, I think, no better route to become successful in this field. Just keep reading and learning all the time, and just be excited by it, because every day I just feel that I'm in a profession that where I'm getting paid to learn and improve every day. There's just so much out there to learn and know about, and that just keeps me very intellectually curious and excited all the time.
Wonderful, wonderful. So Gautam, I've asked you a lot of questions. I can continue that, but we've been joined today by, I mean, more than 200 live audience, and there are a lot of questions that have kept coming in. So I was waiting till the end of the session to take those questions. So with your permission, I would like to take some of the questions from the audience. So one question that I saw, which I can't find now, but I saw that question then, was how do you decide to sell a stock? What is your exit strategy?
Very simple. Everything is a function of opportunity cost. So if I find a much more superior opportunity compared to what I have with me right now, I won't have any hesitation to sell. If I find a stock with potential to give me more than 100% returns in the next 2 years, and I've got an existing stock in the portfolio with the potential to give me 20% returns over the next 3-4 years, I'll immediately switch, no problem. The second trigger for selling a stock is the management engages in gross capital misallocation. I'll give you a good example here. So we hold a company named Saregama in our both as flexi cap and megatrend small cases, and not a stock recommendation, but traditionally one of the key concerns of our investors in that company has been the loss-making Karma business and the loss-making film production business. Recently, they did a QIP of 750 crore rupees, and the management clarified in the con call that the entire proceeds would be spent in the highly lucrative music licensing segment. If the management had mentioned that they would spend that money in the loss-making part of the business, I would have immediately sold the stock without any hesitation. So this is a good example of how you are simply monitoring where the management is engaging in capital allocation. You want to avoid big disasters as far as capital allocation goes. So that's one. Second and third, if any management engages in very bad corporate governance, that's a trigger for an immediate sell. Immediate. Whenever in doubt regarding a company's governance, you should immediately get out. No questions asked. I'll give you an example here. Recently, HGS, Hinducha Global Solutions, they basically sold off a very big part of their business, and the minority shareholders were expecting a very big special dividend. What came as a shock to them earlier this week was the management declared a very small special dividend. At the same time, they increased the amount, they increased the limits for the loans which they can give to the promoter entities. I mean, the stock immediately fell 20% on that particular very day. Now, many investors will again engage in anchoring bias. They will think, okay, stock is down 20% from the day before. Let me wait till I get back to that price where it was just a few days earlier. But that price probably may never come back, because the stock market is very, very brutal, and it's very severe, and it's ruthless as far as corporate governance goes. It will just derate those companies very, very fast. And the stock market, contrary to what many people feel during bull markets, over the long term, the stock market has a memory. Stock markets never forget. And that's why you'll notice many companies, even though they have got very high reported profit growth in the stock market, the stock prices are never bid up, or they never get the high valuations, because the stock market remembers their misdeeds from the previous bull and bear markets. So as far as possible, try to avoid companies with bad corporate governance.
Right. Another question that we have here is that, what is your view on the new age companies which are demanding astronomical valuations, and especially here off late, we have seen some IPOs and some new age companies which are valued at unreal, prices, and straight away right out of the IPO into great big valuations. So how do you analyze those, or
the way to analyze
view
any
on them?
business, whether a traditional one or a new age, so-called new age one, same. You have to have a discount. You have to value them based on discounted cash flow, because valuing these new age companies based on P ratios is meaningless, because for these companies, the OPEX is the CAPEX. In traditional businesses, when they incur CAPEX, then they simply just debit the depreciation amount in the profit and loss statement every year. But in case of these businesses, the value creating initiatives like their marketing expenditures, customer acquisition costs, all of them are 100% expensed in the P&L in the year they are incurred. So for these businesses, the OPEX is like the CAPEX. So they will optically look very absolutely valued. They look loss making, but actually you have to focus on the unit economics of these businesses or the contribution margin. Look for companies with very, very high contribution margins, because for SaaS businesses or software as a service businesses, where you get very predictable, sticky customer revenue for a long period of time, the logical path for many of these businesses is to spend as much as possible on customer acquisition upfront to reap the benefits over a period of next 7, 8, 10 years. So you have to value these businesses based on total lifetime value of each customer. What's really essential in these businesses is whether the customer base is very sticky in nature, and are the businesses having recurring revenues. And that is, you have to understand how the stock market is valuing such businesses. The stock market is simply valuing these businesses. They're taking the total number of customers joining the platform and multiplying that with the total lifetime value of each customer. That's how the stock market is looking at it. But you have to be very careful. I just found one single business so far. I don't want to name it right now, but I just found one single business which is very, very promising among all the number of new age businesses which have got listed in India recently. Only one business really made sense to me. The others I don't think for most of the others there is any defined path to profitability. And many investors, as you've already seen, many of those stocks are down 40 to 50% from their opening day listing price. Many of these stocks tend to list at very big pops, very big premiums to their IPO price. And from their listing price, they've just collapsed completely. The same thing has happened in the US as well. Many hyped, overvalued growth stocks are down 50 to 70% in the last 1 year. So be very, very careful. I think just as is typical with most bull markets, this is also a typical fad. Many of these businesses will fall by the wayside. But out of the debris post the future collapse, you'll get 1 or 2 really big gems out of this particular space. After the 2001 tech bubble crash in the US, many companies a few select companies like Amazon and a few others emerged from that particular collapse as well. So there'll only be a very select few handful of winners from this entire space.
Yes, right. So you've been very active in the US markets also, and you definitely followed that very closely. So what is your view on the US markets currently, since the interest rates are ready to be hiked, and considering the whole interest rate scenario post the second wave of COVID?
Yes, so I think most of the discounting of the interest rate hikes has already been done. The companies which were basically loss-making, zero revenue companies, those are the ones obviously which have got impacted the most, because all of their value was lying in the future, right? So those are the businesses which have got hit the most, and those stocks are the ones which have just collapsed the last 1 year. But if you look at any highly cash generative, highly profitable business, you look at Apple, you look at Google, you look at Facebook, you look at Microsoft, they've hardly corrected. The reason for that is that they were always good businesses to begin with. They were always attractively valued, and they still remain attractively valued. So what the stock market simply did was, in an era of easy liquidity, easy money, free money, they bid up all these loss-making fad stocks. And as soon as the realization sank in that, okay, now the liquidity cycle is turning and now the Federal Reserve will start tightening, they simply took the money home. And the retail investors again were left holding the bag. This cycle always repeats in every bull market, that the retail investors enter at the very end after the story is already played out, after the stocks have already made the big moves, and they get excited especially by the household name. So in US we had a company called Peloton. Just because many consumers were using it at their homes, they got excited by the name. Okay, I like the product, so let me buy the stock as well. But a good product does not necessarily mean a good stock all the time, right? So you always have to pay heed to valuations. Just don't get carried away by the interim fads and fancies of the stock market. The same thing will happen in India as well. You'll see in the next few months, you'll have I think we have got one of the most busiest IPO calendars in history this year. And that itself should tell you everything you need to know. You have to understand, like what Howard Marks calls the temperature of the stock market. Is the temperature hot or is the temperature cold? Right now, the temperature is very, very hot. So you want to just be very careful when dealing with such companies, because most private equity players, they've entered these unlisted private companies at a very early stage. They've basically got most of the capital gains with them now. Now they'll start IPOing and they'll reap the big money. not the investors who put money at these exorbitant valuations.
That's point really to be noted and absorbed. So there's another question we have. It says that how to have percentage allocation amongst the various sectors. Is that a criteria? And if yes, then how do you actually do that?
Yes, I mentioned about the having sectoral allocations and individual stock allocations. So you can basically for any trending sector, any sector in which the earnings growth is really going up in a big way, you can play it through a basket. And I generally prefer to have at least 4 5 different sectors in my portfolio at the very, very, very minimum. I think that basically represent then that way I'll have, and I tend to cap sectoral allocations at 25 to 30%. Generally, it's not fixed. There's no hard or formal rule, but that's generally my comfort level, where my comfort level lies. So 25 to 30% cap on a sectoral level and 20% cap on a individual stock level.
Okay. And there's another question which says that what is the ideal number of stocks in a portfolio?
I already mentioned that in the just some time back, 25 to 30 names, because once you've crossed 20-25 names, then you've captured most of the benefits of diversification. The key is to then let your portfolio naturally concentrate itself. Let your winners run. You'll be amazed at the results you get over time, because winners tend to keep winning and the losers tend to keep losing. And the winners the really great businesses tend to frequently surprise you on the upside. I mean, look at Bajaj Finance, where it was 10 years ago and where it is today. So great businesses keep surprising you on the upside. So when you have found the goose that lays the golden eggs, don't kill the goose. Just keep it with you.
Right. So another question. Let me just see something that we could derive some value out of. Okay, so we have a personal question here which says that based out of US, you with a busy schedule, how do you manage your Indian portfolio? And can you share your, how do you monitor both opportunities in both the sectors, and how do you manage portfolios considering you're in two very busy stock markets?
There's one single answer for that: passion. And like I write in my book, I've dedicated an entire chapter to passion, and there is power in passion. I used to till I quit my job as portfolio manager in July 2021. I used to work in my day job from early morning to evening, and then from evening 7 p.m. till late night 1 2 a.m. I used to track the Indian market. So I never felt it really very difficult, because I was always so passionate about the Indian market. And I guess that's a very simple answer which I can give. It's all based on passion. It's whether how much driven you are by what you're doing every day. But now I'm doing the Indian markets full time. I still track the US markets actively, and I do plan to launch a small case for the US technology space later this year. I think valuations have now finally become attractive after the recent crash. And also one very important point: it's only after a sectoral crash that you get to differentiate between the really durable business models and the business models which were just enjoying temporary momentum. So a lot of these work from home stocks in the US, they were not really structural growth plays. They were just having a temporary boost in their earnings growth. But what this crash has helped me do is, it has very clearly helped me differentiate between the very durable business models in the tech space in US and the ones which were just temporary in nature. So I think now I'm finally ready to bring the US technology investing opportunity to investors in India soon, probably later this year. Once small case company gets the necessary regulatory approvals, then I plan to launch a US technology small case as well.
That's something we'll be looking forward to. So, is there another book in the offing, Gautam, or?
Well, I've been approached by many publishing houses after the success of The Joys of Compounding, but I just feel that I think now at this time in my career where I want to utilize all my experience and expertise to build generational wealth for many investors now. And it's time to put study and theory into practice, and now finally become a practitioner in the real world. And I would just like to thank all the readers from across the world for helping make The Joys of Compounding an international bestseller. When I first published the book, I never expected it to become so popular, but it has really helped me a lot in my career. And I hope to keep adding value to all my readers and my investors in my Indian venture as well as the upcoming venture in the US, which I'm planning.
Wonderful, wonderful. So I think one final question, since again you're well versed with the US market. So for a retail Indian investor, what should be, I mean, how should they do their international allocation? Is there a percentage? Is it a good time to step in when they're still exploring equities? So how does one understand international allocation?
So allocation is is a question of personal conviction and personal levels of comfort. But I can advise on how you can start. So you can start with the Nasdaq ETF offered by Motilal Oswal. That's a very popular ETF in India. You can participate in the broad-based growth of technology in the US. If you want to invest directly into the US markets, I would recommend you can try platforms like Grow and Vested. So these are two very good platforms through which you can start investing in the US market. And there is one more, I believe Interactive Brokers also allows Indians to invest in the US. So Grow, Vested Finance and Interactive Brokers, you can explore these platforms if you want to invest directly into individual stocks in the US. But start off small. I think as is the case with most investing, just start off with a small allocation, less than 5%, then gradually build it up over time. Don't put a large amount of your money in the very beginning, because investors should ideally start off small and then build it up over time.
Right. And a question that I've asked pretty much everyone who's been on Investors Talk is your view on cryptocurrency.
I'm a firm believer in the underlying technology of crypto, which is the blockchain. I think it has a great future. But since cryptocurrencies do not produce any cash flows, I've got no expertise in valuing them, so I just stay away. I think I'm happy with the Warren Buffett way of getting rich slowly but surely, rather than trying to become rich very fast. So I don't have that ability, unfortunately, but I believe in getting rich slowly but surely. And I'm a big believer in the power of long-term compounding. So you don't have to do exceptional things to be exceptionally successful in the stock market. Just understanding how compound interest works will do the work for you. So as an example, if you compound your money at 20% for 25 years, your initial capital becomes almost 100 times at the end of year 25. But note that out of that 100x, almost 2/3 of that, or 62 out of the 100x, will come in the last and final 5 years. At the end of year 10, you'll have 6 times your money. At the end of year 20, you'll have 38 times your money. So you will make 62 out of the 100 only in the last and final 5 years. Compounding will bestow its benefits and magic upon you only after testing your patience and conviction to the very fullest. And that's why you see very few rich people in the stock market, because one or two sharp corrections of market crashes and bear market and they're out. The stock market is not meant to be easy, right? It's a test of your emotional intelligence and your emotional character. So there's a saying which goes like this: if you don't know who you really are, the stock market is a very expensive place to find out. So you'll get to know how you really are. Enter this place, you'll get to know.
Yes, absolutely, absolutely. We've seen since the last 2 years have been so volatile, and we've seen a lot of temperaments playing in the last 2 years itself. So yes, great lessons from you, Gautam. This was such a wonderful chat, and thank you so much for sharing so extensively and comprehensively your knowledge, your various things that you've underlined in your book. But it is so good to talk about them with you. And I think somebody asked me if they could watch this again. So definitely this will be on our Instagram page, and a YouTube link will also be floated on our Twitter accounts, and I'm sure Gautam will forward those as well. So yes, this interview is very precious to us, and we will have it bookmarked for a very long time. And until we talk again, thank you so much, Gautam, for being here today, sparing out your valuable time on a Saturday night there. So thanks ton for joining us. Thank you so much, and thank you so much, everyone. I think we had the highest numbers of viewers today, Gautam, live viewers who joined us. So yes, you are popular, and thank you each one of you who has stayed through the entire chat and really encouraged us. Thanks a lot.
Thank you, Shaina. This was a pleasure. I wish all your viewers and the audience a very happy and successful 2022.
Thank you, Gautam. Thanks a lot. Bye-bye. Thanks.
Bye.